Good morning. Hi, Ron. Good
Hi,
morning,
Kath.
everyone.
Oh,
Okay.
look at your new studio. What a gorgeous
Oh,
place.
yeah. Look at my new studio, everybody. Yeah, this is my new studio.
Very nice.
Really, thank you. Very excited about it. So, today is another Baby Boomer Investing show. We're in season 2 already, and we got the episodes up there now. So, what are we
We have
talking about today?
libraries.
Yeah.
Libraries. Please come visit our libraries.
Yeah, I got
And
the link that you sent to me, so we'll post that and then we'll show it too.
sure, great.
Okay,
Thanks,
so
Kath.
what are we talking about today?
Well, we're going to talk about the new regime, the new president and vice president, and what their platform is, so we know what to expect. But most importantly, I want to talk about the things that have been lingering and threatening the economy and the stock markets. We've been talking about that for basically all of the shows. But now with the new regime here, I just wanted to remind our viewers that these things have not gone away. And the new president and vice president elect may not have to deal with them, but it wouldn't surprise me if they do. So we're going to go through two things. One is what we covered in our last show, which was the platform for Biden Harris and what they're going to do about taxes and healthcare and all that. And then we're going to go beyond that into things that are not on the platform. And these are the kind of things that politicians ignore. They just they're 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 fraught with peril, so nobody wants to talk about them, but they're definitely there. So this should be one of our more important shows.
Okay, so do you want me to start with
Start with the first slide with the plate.
okay, here we go.
So this is about the next 4 years and what President Biden, President-elect Biden, and Kamala Harris have on their plate. COVID is one everybody knows about, and they certainly ran on that, and I think won, largely because COVID is the threat that it is. We'll talk about three other threats. In our second episode in February, we talked about 10 threats. Today, we're just going to cover four, but I think they're the more important ones. And let's start with what the Biden platform is. It's on the next slide. In our previous show, we had Mike Halloran from Janney Montgomery Scott, so season 2, episode 4, go through in detail the platform. I've just summarized some of the high points here in this slide, but let me go through them quickly. In taxation, the plan is to raise taxes, but I wouldn't say that anything here is so dramatic that it's just going to really affect most people we know. You're going to raise the corporate tax back to 28%. Trump had cut it from 35 down to 21, so it's going back halfway. The maximum tax for those earning more than $400,000 would move back up to almost 40%. And then one of these things that wasn't on Mike's presentation 2 weeks ago, but I found this interesting. Biden is proposing that instead of giving a tax credit for people, instead of giving a withholding the amount that you contribute to a 401k or to a pension plan, to issue a flat tax credit. Now that to me makes a lot of sense, and I think it's I like it. So what I'm really saying here is if you are wealthy and you contribute $10,000 to your IRA, you hold back that $10,000 from your income. So if you're in a 40% tax bracket, you're really holding back $4,000 because you get $4,000 tax credit. Someone who is in a 10% tax bracket contributes that same $100,000. They only get like maybe 10% of that, so $1,000 tax break. And what Biden is saying is just make it a flat 20%. So the guy that does $100,000, he'll get a $2,000 tax credit. The guy who's wealthy in the 40% tax bracket, he'll still get the same $2,000 tax credit. So I'm not sure I explained that right, but I hope you get the idea. It's a total change from what we've been doing for contributions to pension plans. So
So is that a good thing or a bad thing?
I think it's great.
Oh,
And one of the things it does is I think you can present the idea as a contribution match. So you would say to anybody who contributes to a IRA or to a 401k plan that the government's going to match 20% of your contribution, and you're going to get that in a tax credit. And that's just so easy to understand, and so much, I think, leveling the benefit. So the rich people are really getting more of a benefit because they're in a higher tax bracket, so they're getting a higher tax deduction. But this would be a flat, say, 20%. And I think it will encourage people to contribute to their pension plans. So I think it's all good.
okay. Sounds good.
Yeah, I think so. Then on the energy front, Biden really campaigned on supporting renewable energy and limiting fracking. I think the debates said he was going to outlaw fracking, but I don't think that's really true. One of the things limiting fracking does, though, is we're now energy independent. We don't need to rely on Saudi Arabia or anybody else for our energy needs. I'm not sure if some of the fracking was taken away, if we wouldn't become dependent again. But I just don't know enough about that to comment with any authority. Infrastructure spending was very much on Biden's campaign. He plans to spend a lot of money, like $1 to $3 trillion. And God knows we need infrastructure investments, like certainly on the East Coast, where these pipes have been in there for hundreds of years. Bridges are falling apart. We also have needs on the West Coast for our power grid. So that's an important thing. Health was, I believe, what won the race. And certainly if the COVID epidemic had not struck, I think it would have been a much tougher battle. But here we are, and Biden has promised to deal with COVID. And I'm going to talk about that in terms of the threats facing us, so that put off discussing that with a lot of detail right now. And then to bring back some sort of health care for all, probably patterned after Obamacare, the Affordable Care Act. So that's going to hit. Well, by the way, all these things are going to need to go through Congress unless Biden uses executive orders. And it may be, although it's not looking like it will be. So right now, the House is Democratic, and the Senate right now is Republican. It may not be come January. So there's two runoffs in Georgia, and the outcome of those runoffs will determine whether the Senate controls, the Republicans control the Senate or not. If Democrats have the House and the Senate, these measures will almost certainly go through. So be aware of that. Then the next thing on the slide, Kath, foreign affairs. Technology. Plan is to invest a lot in emerging technologies, artificial intelligence, and the like. $300 billion is a fair amount of money, so that's a pretty substantial commitment. And then on foreign affairs, very much signaling being nicer to people around the world, and in particular to, I don't know if he'd end the trade conversations with China, but certainly not be as firm and aggressive as we have been. Strengthening alliances. I used the word placate Iran, and I just heard on the TV as I was getting ready today that something's going on there. And I think Iran is expecting us to be the nice guys that we were in the Obama administration, sending them money. Oh,
really?
I think that's the cards.
We don't have enough for us.
Well, that's absolutely true. And we're certainly going to talk about. Well, we are going to talk about that, but what we're going to talk about in the context is there's this theory that we can't run out of money because we own the printing press.
Yeah, right.
So there's certainly that in the mix. So I wanted to spend a second on healthcare in the United States. And I came across this chart maybe about 6 months ago, and it's really cool. You have to spend some time with it. But this is from a firm called Payden and Rigel, and I think they're located in Los Angeles. And what this is, on the horizontal scale, moving from left to right, is how expensive healthcare is. And then on the vertical scale is the quality of the healthcare. And the green dots are Asia, the yellow dots are Europe, and the red dots are the Americas. Look at the lower big green dot. The size of the dot is the number of people. So India is way down here. Really lousy care, but good news is they're not paying much for it. But they are to the right of that line, which says they're paying more than what this analysis would suggest is fair. So the line sort of dictates fair amount of health care for the price. If you move up to the next big green dot, that's China. And the yellow thing inside there is Russia. So China and Russia are to the left of the line, which says that they're for what they're getting a really good price. So they're not getting the quality that we're getting. And then way over to the right-hand corner, Kath, upper right-hand corner, that's USA.
Oh, geez.
We are paying way more than anybody else.
Really?
And we're getting good quality health care. But if you move over to the left, the countries in that box are mostly in Europe. So Ireland, for example, is getting better quality health care for us than us, and we're paying more than twice what they're paying.
Well, why is that? I'm not understanding. Help me here.
And I think it's historical.
Oh,
and it's just
okay.
been, that a lot of the research and development has been done in this country. And when I've showed this to other people, they say, yeah, we're paying for the development of innovations in the healthcare field. And in particular, I'll even tell a personal story. So I need to use this inhaler. And it's not on the list of what's covered by my insurance, by my drug company. So I have to be out of pocket for it. It's $330 every 3 months here. So it's pretty expensive. I went to Global RX, which is an online place where you can order drugs.
Right.
$50.
Yep.
$50 instead of $330.
Yeah. Isn't that amazing?
Yeah, and but the warning is supposed to be that you don't know if that was copied and it wasn't the real deal and it's been made in other countries and packaged to look like the real deal. But I tried it once about 5 years ago, and I think the drug was effective, so it worked. I guess that's the important thing, even if it's labeled. It's not really made by the drug company who developed it, but.
So it's a generic, but so what?
Well, it's not even generic. On Global RX, it was the name, and it came in the package just like the real thing.
Oh.
And the pills looked identical to the real thing.
Uh-huh.
So it's not even being presented as a generic. It's being presented as the real thing for a lot lower price.
Wow.
So again, I think it is the real thing. But I have read stuff where people have been deceived by ordering stuff online like that. But
right.
Anyway, I've had a good experience for this drug anyway. So that's healthcare here. Let's go on to what the threats that lie ahead that I want to discuss in detail. So we definitely want to cover COVID, and I want to talk about not just the health risks, but the wealth risks. And then in the past, we've talked about these things, the debt crisis, market bubbles. Actually, we haven't talked about social unrest. We talked about it a little bit in one of our shows. So I'm going to tell you where you can find more detail in shows that we've done before, and then just briefly cover what the new administration is going to be having to tackle. So we'll start with COVID on the next slide, Kath. And the thing that seems to be happening, certainly in the stock market, is that somehow this reaction is like the Fed throwing money at the problem is miraculous, that it's all good and stocks are going to thrive and the economy is going to thrive. And I think that's not true. we're going to talk about why that could backfire on us, the people watching the show. So let's go to the next slide, Kath, about the health and the wealth. So in the 11th episode of our first season, we talked about this. And on the health front, Biden has been very clear that this is a serious threat. And Trump came through his episode so quickly that his being a little cavalier about it, I think, was sort of a proof statement they came through this so quick. But Biden is very much, wear masks everywhere. And I think now with the flare up in the COVID, that this emphasis on masks is going to be very real. Kathy, you said it is by you now in Massachusetts.
Yeah, we're in lockdown again.
Yeah, so it's serious. The good news is, and I think the Trump experience sort of bears this out. The therapies now, the therapeutics, are much better than they were in February when we first identified the virus. So we've learned what sort of chemical cocktail works best. And in Trump's case, I think he was through in 3 days.
Mm-hmm.
And then we followed, I don't know what they all loaded him up with, but they gave him doses of everything.
Yeah.
And it seemed to work. So,
yeah, the same thing with Ben Carson. I heard that he's got it too. And he did the same therapy that Trump did, and he was fine in 3 days. So I'm not exactly sure what the combination was, but apparently whatever it was worked. I don't know that it's available to the public.
That's a good question. Yeah. So that's the good news. We're learning more and dealing with it better. But the ultimate really good news is 2 vaccines now have been identified as being effective. One from Pfizer and one from Moderna. So what I heard yesterday was these vaccines will probably be available to the frontline healthcare workers before the end of the year, which is really good.
That's great.
And for the people who are boomers, they also said that they'll probably also make it available to older people. So we might be the first to get it. I know people are leery of being the first to get a new vaccine, but I think by the time
I'm leery.
Well, yeah, we're not, but I guess we're all entitled to our fears. So we'll see how this plays out. And I guess maybe the thought would be, let a few months pass by and see if people really are getting sick from the vaccine. But that would be an approach. But I don't know if you pass it by the first time, I don't know if you get a second chance. Most people are thinking about when the vaccine will be generally available, are looking at June of next year. So it's going to be a while, I think, before the vaccines are in a lot of people. So the government's supposed to pay for that. And we move over to the right here. There are definitely wealth effects. The economy is in the tank. So productivity is down, employment is down, things are grim. But the stock market keeps going up. And
that's so weird.
I know. We've talked about that. We're going to talk even more detail about. There's a bubble, and it's debatable. And I'm actually going to touch on something I didn't touch on before about why I think the stock market keeps going up, and I think it'll be interesting because I think I'm seeing it right. So what's happened with the COVID relief is we all got checks, and that's called helicopter money, and it was $3 trillion. And the next round of COVID relief has not yet been approved. And I think it's just because we're in transition now from a Trump presidency to a Biden presidency, and nobody can agree on how much. But it's looking like it would probably be another $3 trillion. And that helicopter money, we're going to talk about it some more. So just be aware that it's helicopter money. So let's move.
What does helicopter money mean?
Well, it means instead of giving it out to certain people. By the way, quantitative easing, that money only went to a handful of people, mostly to banks and to the really wealthy. So that money was not helicopter money. That went to a select few people. It actually increased the divide between the rich and the poor. So the rich got a lot richer. This newer round is being sent to everybody. You got a check, I got a check, everybody got a check.
Yeah, right.
That's called helicopter money.
Everybody got a check.
Right. So literally, they could have flown overhead and money would be all over, but that means that the people who are faster would get more of it than the people who are slow. So this way, even the slow people get some money. So that's the idea of helicopter money is for everybody, not just the elite. So that sort of triggers the next topic of conversation, which is the debt crisis. And we have spoken about this before, but the important thing to really bear in mind, and I think people are reacting to this, paper money is just paper. So if you look in your wallet and you've got a $20 bill, if for some reason the local store decided that they didn't want that money, that would just be a piece of paper and you could throw it out. And that has happened in the past. Venezuela actually went through something not too long ago where those pieces of paper became almost worthless. So I'm not saying it can happen in the U.S. I'm not saying it will happen, but I'm saying it can. So I'm going to talk about just an overview of what we spoke about in the previous. We'll go to the next slide. So there is a debt crisis. One of the articles I wrote got about 60,000 readers. So it really, in my world, that's going viral. It's not the millions that are going viral on Facebook would be, but in my world, that's a lot of readers. And the article is that global debt exceeds $200,000 per person. And I know we talked about this, Kathy. You already sent yours in, so you're good.
Yeah.
Yeah. We're not worried about you. But all these things around the circle here are sort of symptoms of the disease. And the disease is basically the world has spent more than anybody really is even remotely aware of. I mean, if you think about, if what it means, $200,000 means to you, to me it means a lot, and to certainly a lot of other people. And then the thing that really brings it home to the boomers is that on the right-hand side here, our gross domestic product is $21 trillion. Our official debt is $27 trillion. And that's sort of the basically the amount that the Treasury has borrowed and other things we owe. So that's a little over 100% of GDP. And the alarms start going off when we owe more than what we produce in 1 year, which is the case right now. But the off-balance sheet debt, like Social Security and Medicare, is $78 trillion.
My God, look at that. Holy mackerel. Wow.
And it's not just me. It's Professor Lawrence Kotlikoff from Boston University has been writing extensively about this. And he also writes about how Congress could begin to fix it. But the longer they wait, the worse it's going to get. So from what it appears is that our regulators are going to wait for something to break. And then the things that they can do will become harder and I think more painful. So Social Security is forecast to go bankrupt in 2026. The COVID thing has escalated that summer, saying it could be as soon as 2023. Medicare in 2034. So that's all at hand. But the good news is on the next slide.
Okay.
And the good news is we can't go broke because we own the printing press.
Uh-huh.
So I know there are people who really support this modern monetary theory. One of the people might be on Facebook and want to chime in here. I think I get it, and I think what happens. By the way, in the upper left-hand corner, what happens when we quote print money isn't really running the printing presses. What really happens is the Treasury borrows money, and currently, the normal people who would lend us money, like China and Japan and our U.S. citizens, they're tapped out. So the new issue of Treasury money isn't being taken by anybody. So the Federal Reserve has had to step in. So all of those new issues, when you got your $1,200 check, that was generated by the Treasury. They borrowed $1,200 to send you the check, and the Federal Reserve lent them the $1,200. So you get the idea. It says robbing Peter to pay Paul.
Mm-hmm.
So that's going on. And the modern monetary theory people basically say that's good. Just print as much as you need, but be careful. Because if it starts to cause inflation, then you've got to back away. So sort of the experiment here is to print and print and print. And then when you see inflation heating up, you're supposed to stop it.
Mm-hmm.
And in fact, you may even have to take some of that money back. Now, the way you take that money back is to raise taxes. Do you think our politicians are going to? They're mostly worried about getting reelected. They're not going to. I don't know. We'll see what happens when inflation flares up, and what the political reaction will be. But here's the other thing that's gone on with quantitative easing. Inflation hasn't happened. And there's been like a cheer, like this experiment worked. We printed all this money, and this consumer price indexes hasn't budged. No, we're under 2% inflation, and the Fed is saying its target is 2%. And they've actually announced that they're trying to reinflate. They're trying to get inflation to go up, because disinflation, also called deflation, is also bad for the economy. So the mark here is for the 2%. Now, the reason inflation didn't go up in the consumer price index is that money all went into people who buy stocks and bonds. So the stock market is a bubble. The bond market is a bubble. The bond market is easy to see. Oh, by the way, one of the cool things here that I really like, one of my friends, Larry Siegel, just was writing about how we deal with this money printing thing. And one of the key things that you want to do as a government, if you're going to print a lot of money like that, is don't pay interest.
Yeah.
So that's what they've manufactured.
Oh my
God. They're not paying interest.
Wow.
And that's the thing that you can see ways where that could break. And I won't go into that, but when I talk about the stock bubble, the existence of zero interest rates really has made stocks more valuable, but also some of that money has gone into the stock market, so it's inflated both the stock and bond market. COVID money, this helicopter money, is going to people who are buying groceries with it and paying their rent and not going into the stock and bond markets. And that's the money that could easily cause the consumer price index to increase. So let me just put this differently. There's an article that just came out that talks about the two kinds of inflation, and it very much plays to this. There's asset price inflation, which is what's driving the bubbles in the stock and bond markets. And then there's consumer price inflation, which is what's going to be caused now by the COVID relief money. So the debate is on the next page, which I've been following, and it's funny. There are some really smart people are saying, we're not going to get inflation. You're crazy. There are all sorts of reasons why deflation is here to stay. And I listen to the reasons here. The fact that wealth is concentrated with just basically the top 1% of the population are going to show that. And those people are not buying the things that move the CPI. They're buying yachts and other things that don't even enter into the calculation. The banks are limiting their lending, even though they have plenty of reserves. Our population is aging, which slows down growth. We have technological advances, and I'm just still amazed by the progress on what we call phones. They're not phones anymore; they're computers.
Yeah, right. Yeah, smartphones.
Yeah, they're really smartphones. We have an abundance of energy, and then the other thing that keeps prices low is outsourcing. As long as we can go to other country and have them manufacture our goods for whatever they pay their people to do, that's deflationary. So there are a lot of strong deflationary factors in play. So how much money will turn the scale to inflation? Nobody knows. But some amount of money will. I mean, it's just a natural thing. But so what I'm showing here are these stacks of bills. And quantitative easing was $4 trillion. Then we added another 3 in COVID relief, bringing it up to $7 trillion. And there's probably going to be at least another 3 for more COVID relief. So that'll bring it up to $10 trillion. The gross domestic product is $20 trillion. So some amount of money, maybe it's not 10 trillion, maybe it needs to go to 40 trillion or something. Will bring us to inflation. It's unless we stop. So the old cowboy saying is, you find yourself in a hole, stop digging. I don't know politically if our regulators can withhold any more humanitarian relief because people really are suffering. So I think the question is not will they do more relief, but how much will it be? And don't consider
when.
And everybody's in a hurry. Everybody wants it now because people can't pay their rent.
Yeah, or mortgage or whatever.
Yeah, whatever, exactly. So people are a lot of people are in deep doo-doo. So for those on the call who want to get out ahead of inflation, on the next slide, I'd show you the ways I could think of. You might be able to think of some more. So precious metals, they've always been a safeguard, and gold has certainly been going up in this time. There's concern. Cyber currencies, Bitcoin, I just heard, hit a new high. And on our next show, we're going to have an expert join us, Maury McCoy, and he is going to educate us on cyber currencies. So I personally want to know about them. The way they're manufactured has really been a mystery for me. I'd love to understand that better because theoretically anybody could make a cyber currency. I think it's just a computer thing that crunches something and builds money. Real estate is an inflation defense. Treasury inflation protected securities are the standard, and commodities because they are one of the measures of inflation. So those are ways you can sort of protect yourself. Then I want to change gears here and move on to the bubbles. And on the next slide, we talked this in our last episode of season 1. We talked about the bubbles in the stock and bond markets. And in that episode, I talked about, I think, at least 7 indicators that we have a bubble. And I'm showing you one that I really like because it's got Warren Buffett's name associated with it. And I really like it because it succeeded in every case to predict a market crash. And I won't go through the history of how it succeeded, but what I wanted to point out to you is where we are now. So we, by the way, the thing in the bubble there, the FANG, is Facebook, Apple, Amazon, Netflix, and Google. They're called the FANG stocks. Those 5 stocks have really driven up the value of the stock market. They're just incredible. Apple at $1 trillion is just incredible. So
yeah,
and they keep going up. And I sort of think the feeling is, those are great companies, and then there's no limit to how big they can grow. There is a limit. So we came into 2020. Same 2020, 2020. The Buffett measure is the ratio of the stock market's value to gross domestic product. In January of this year, the stock market was 180% of gross domestic product. Normally, that ratio runs at around 80%. So when the ratio starts to become above 80%, it's starting to signal a bubble. Then in February, when we identified that COVID is a pandemic, the stock market went down by 35% from the middle of February to the middle of March. And a lot of people, including me, said the COVID is the match that lit the overvaluation tinder. that 180% was already telling us that the market was in a bubble. And good news, the bubble burst, and now we can get on. But the getting on wasn't to go back to a bubble. The getting on was, that the market was settled down at around that level, but it didn't. And people are calling that a V-shaped recovery. Going back to the graph, Kath.
Oh, okay.
Now, this isn't really a V, but it's close. What people are really saying is we came back from that decline, and it's gotten even better, and it's going to get better and better, and all is good. We dodged that one. Hooray. So now, instead of where we were at the beginning of the year at 180%, we're now at 220%.
Wow.
And that is, to put it into context, if 80% is the norm, where we currently are is at 275% of the norm, almost 3 times the norm. So this bubble is inflating and inflating, and we all know that bubbles, you can't inflate a bubble forever.
It's going to pop.
It will eventually pop. And to get us from where we are today at 220% down to 80% would be a 60% correction. So that number has come up in several articles that I've read about people who talk about the bubble. The other thing I'll say that sort of supports this 60% correction idea is some have said that the current prices are justified because interest rates are so low. And part of that is true. So bringing interest rates down from 5% to under 1% should have caused stock prices to increase by about 50%. That's true. And what that means is when if you're valuing a stock, the discounted dividend model is most popular. So what you want to do is look forward to the future earnings, discounted earnings model, forecast those earnings, and then discount them back to today. And if you're discounting them at 5%, that's one number. If you're discounting it at a lower number, like under 1%, that's a much higher number. It's about 50% higher. The stock market during the time period that interest rates have come down over the last 10 years has increased by 250%. So 50% of that 250% is due to the interest rates. Now, what does that mean in terms of the correction? If the manipulation of the bond market were to end and interest rates were to go back up, not real high, let's say another 5%, that would trigger a 50% decline in the prices of stocks. So the good news is 50% up as interest rates went down. The bad news is that's going to go back down again when interest rates go back up. So what will be the catalyst for interest rates going back up? I don't know. But we're always surprised. Every crash that has happened is normally triggered by some catalyst, but it's bursting these bubbles. Now, on the next slide, I want to share something with the people who are watching the show. In preparation for this show, I read and watched everything I could find from investment management companies about the bubble. The bubble doesn't exist. The most recent one was Goldman Sachs, basically saying 2021 is going to be the best year ever. Goldman Sachs is a great firm. Some really smart people work there. And this was a headline that is cut out, and they're showing that the bull and the basis for 2021 being the best year ever is the day that Pfizer announced that it had the vaccine. So here's this really prestigious firm telling everybody that the future is rosy. I hope they're right. But what I'm saying is the stuff I'm saying, this doesn't seem to be acknowledged or believed by these major companies. JP Morgan, no. US Bank, no. Janney Montgomery Scott, no. And I think you watch these people and you can see them. I mean, these webinars, these people, I think, believe what they're saying. But when I shared this with one of my friends, and he said, they would shoot themselves in the foot if they were to say that they are worried about the stock market, because their business
is about the stock market. Yeah, right.
So I don't want to question their integrity, but I do think that the motivations could be affecting their judgment and their outlook. I think they want to see really good stuff in the future. So that brings us now to the wealth divide. And this is really painful. So we have social unrest here, and you see it every day on the news. I do want to say something here that's sort of cool. I was wondering where the money's coming from for Black Lives Matter and for Antifa and stuff like that. And I wrote this down. Black Lives Matter is being funded by Airbnb, Amazon, Apple, Coca-Cola, Facebook, Nike, YouTube. Big companies are funding. Now, Black Lives Matter, it's true. Black lives do matter. But the agenda for BLM, this, I think, is very disruptive. And no, the protests are not protests, they're riots. So I'm going to show you on the next slide, Kath, why these things are happening. And certainly Black people getting killed by police is not a good thing, but I really think most of this is being generated by the wealth divide. So on the left-hand side here, we have 300 million people in the U.S. 150 million of them own less than 2% of the wealth of the country. That's the red line on the bottom of the chart.
Wow.
A lot of people who look at all the others, and I think by global standards, those people are not poor, but by national standards, they just see these people driving their BMWs and living in their mansions and all that stuff and saying, I want some of that. I live in this rich country and I want some of that. Then if we go all the way to the other extreme, the blue line, the top 1% own 30% of the wealth. And the little dips there that you see in that line are revealing. That's when we had the stock market crashes. So much of that wealth in the top 1% is held in stock and bond markets. No surprise. Now, the moral of that story is when the stock and bond markets decrease in value, some of that disconnect gets resolved. The 1% are less wealthy. But no, I don't feel sad for them. Maybe I should. The other thing that's revealed in these lines is if you look at the black line at the top, the people in the 90 through the 99th percentile, it doesn't include the top 1%, have been enriched by quantitative easing. So that's where the money's going. It's going to the wealthy people, and they're putting in the stock and bond market. And at the same time, the gray line, which is the people who are above median, but they're not in the top 10%, on a relative basis, they've lost ground. So at the right-hand scale here, the sort of bottom line is the top 10% own 68% of the wealth. The bottom 90% of our population own just about a third of the wealth. So that's causing, I think, an appeal for socialism. And I think Bernie Sanders is sort of proof of that. He's gotten a lot of followers, a lot of support. The other levelers are on the top of this page. Taxes would help level it. And certainly there's sentiment for, especially for wealthy people who pay no taxes, that just doesn't seem fair at all. Market corrections will modestly bring things back in line. But socialism, I think, is something that's very much on the horizon. And on the next slide, it sort of summarizes what we're seeing. So these protests are really riots, and it's sort of an announcement, hey, free stuff. Come and break some windows and get your free stuff. And that's just wrong. That's just wrong. I don't think socialism condones that behavior, but I do think that it's symptomatic of a public uproar that's going on. And the big divide between the rich and the poor on the lower right-hand corner, I looked this up. At least the internet thinks that Bernie Sanders is worth about $2 million. So that doesn't put him in the top 1%, but it does put him in the top 10%. So in some ways, I'd say good for him, because he's not in the group that's hurting, sort of crying out, "Give me some." I think, to his credit, he's really sitting there going, "This is not fair. The poor people are too poor. We need to share some of the wealth." Now, to go to an extreme, on the next slide, Kath, this unrest could turn into a revolution. It wouldn't be the first time. And probably the best such revolution was the Bolshevik Revolution in the 1920s. And people basically then overturned the czars. So the czars were the Russian version of our 1%. And the populace said, "You've had enough. It's been long enough. We're taking it back." And that sort of sentiment, I think, is what we're seeing now with BLM and Antifa and others like that. So the message for boomers, the people on the show, is on the next slide. And it's the same one every show. And I just want to drill it in, that baby boomers are in this risk zone, the 5 to 10 years before and after retirement. So consultants will tell you, you need to identify your investment objective, and I will help you reach that objective. Whatever you want to do, just tell me what it is. Your number one objective at this stage in your life should be to protect your lifetime of savings. That should be your number one objective. Because if you lose it, and as you've seen in these previous slides, there's reasonable possibility that there will be market crashes, certainly in the next 10 to 15 years. Your lifestyle will not be good.
You got to go back to work.
You try.
Yeah.
That would be one thing. But the other telling thing is the old 60-40 stock bond rule is very much entrenched. And I'm reading more and more lately that a 60-40 bond rule is dead, but it's not. It is the average asset allocation for everybody: 20-year-olds, 30-year-olds, 40-year-olds, 50-year-olds, 60-year-olds, 90-year-olds. It's the average asset allocation according to the Employee Benefit Research Institute, called EBRI. So that rule has somehow gotten itself very much into everybody's portfolio. So you may not even know what your asset allocation is. If you don't, you should certainly look. But if it's anywhere near, by the way, the criticism has been of the 60-40 that the 40% in bonds isn't safe anymore. So that's not the safe asset. But the truth is, stocks aren't safe either. They're even gotten riskier. So that's not a good mix. What you really want to think about is moving to very safe assets like Treasury bills, Treasury inflation protection securities. Move yourself to safety. So in summary, on the next slide, Kath. Hooray for Biden Harris. I hope they have a great presidency and do well for the country. I just read a quote that there was politicians concern themselves about getting elected. Statesmen concern themselves about the next generations. So I hope Biden and Harris are good statesmen and will address these problems before it's too late, because I think the behavior of our regulators has been, we're not going to deal with it until it breaks. And I just hope this administration can deal with it when it does break, because it's a good chance it will. So on the next slide, just a reminder that listeners, especially boomers, need help. Actually, we're sort of asking them for help here first. Please help us. You can help us on Patreon. It's a website, and you won't have any trouble finding us. But we can help you. We have a self-help website called 8-Stage Robo. If you want to use an advisor, at least get a second advisor's thought. Glide Path Wealth Management. Certainly watch our Baby Boom Investing show. We have a pretty robust library now in this building. And then for fiduciaries who might see this, we have the smart target date funds that have been in existence since 2007. So they've been around for quite a while. And that's it. Next week, tune in for education on cyber currencies, Bitcoin, and things like that. And thanks for listening.
Whoops, didn't mean to do that. I meant to put you up. Oh, Ron, that was a great show. Thank you guys very much. We will see you
in 2 weeks.
In 2 weeks.
Yeah.
Okay.
Thanks,
Bye.
again.
Bye.
Bye.